Hey, everybody. Good to be with you today. Happy Wednesday. My name is Brent Moore. It's time for Managing an Options Portfolio. We do this each week where we talk about some different things, including managing various options trades. We'll get to those this session as well. We're also going to talk about some important associated topics with managing an option portfolio. That includes knowing what your deltas are, your beta weighted deltas, how to beta weight. We're going to hit all that up here in just a minute. But before we do that, let me just mention this. I'm joined by Ben Watson in the chat. Appreciate Ben. I've been working with Ben for over 20 years now. He not only is on the road with Schwab a lot, helping facilitate these and lead these workshops that we do. But he also teaches some webcasts, including a trading futures webcast. If you're interested in futures, I encourage you to check that out. It occurs on Tuesday mornings. You can follow Ben or myself on X at Brent Moore CS, at Ben Watson CS. Make sure you do that. And before we get too far into this, let me just mention that options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And that's different than on the paper money platform, where you will not get assigned early on contracts. Rolling strategies can entail additional transaction costs. The material today is intended for general informational and educational purposes only. The paper money software application is provided for educational purposes only. For the sake of simplicity, the examples in this presentation do not take into consideration commission or other transaction fees. Past performance is no guarantee of future results. All investing involves risks, including the potential loss of principal. Let's head on over to the Thinkorswim platform. I see some familiar names in the chat. Welcome to all of you. Glad you're here. And if you're joining for the first time, glad you're joining me as well. This is the S&P 500 here, folks. And you know what? Last week we talked about different trades. We talked about various trades. And in those trades, we talked about being aware of what the delta is on the position that you were trading. So various strategies entail higher or lower deltas, and deltas tell you how much that position is going to profit or loss, essentially, based on a move in the underlying stock. Okay? And so that's a key concept. If you didn't see that, I'd also encourage you to check that out. I just put a link to that show, that webcast in the chat. If you're watching on a recording and don't see the chat, you can just go to the playlist for Managing an Options Portfolio. It would have been a week ago, which would have been, I don't know, November 26th, maybe 27th, it's around there. And this week we're going to talk about an associated concept, and that associated concept is called beta weighting a portfolio, which uses delta. So let's talk about that. First of all, let's talk about what beta is, because this is important for a portfolio. It's probably a term, it's likely a term you've heard. If I go to the trade tab, and you may need to open it up if you have this kind of two-line deal here, and you look at a particular stock, you can look at its beta. Let me put up NVIDIA, just a company that everybody's familiar with. Here's NVIDIA, and it's loading, and you'll see mine says fast beta. Yours may say beta. Beta just goes back 5 years. Fast beta is just going back a year, so the calculation may be a little bit different. In fact, it probably will be a little different, but the same principle applies. It's basically how much is this stock likely to move in relationship to a 1% move in the S&P 500. A beta above 1 would mean that it moves more than the S&P 500. In other words, about 1.8% more, or excuse me, I guess 80%, 1.8 times as much as the S&P 500 moves. So a $10 move in the S&P 500 would, on average, it's just an estimate, it's backward looking, but it would move around, instead of a $10 move, it would move about $18 or an equivalent amount, okay? So about 80% more, I guess, in that is the way to think about that. Now, that's great if the S&P 500 goes up and you have a high beta stock. That's what explains a lot of performance in the market. When you're listening to someone who's pitching them to manage your money, often what you'll hear them say is, hey, I outperformed the S&P 500. I did better than the S&P 500. Could it be that they just have a lot of high beta stocks when the S&P 500 went up? And if you have high beta stocks and the S&P 500 goes up, you're probably going to outperform the S&P 500? Is that a possibility? Probably. Now, why doesn't everybody just load up on high beta stocks? Because sometimes the market goes down, and if the market goes down, these are likely to drop significantly more than the S&P 500. Okay? So, now, if you're interested in the difference between, now in the chat, I mentioned this, fast beta goes back 1 year, beta goes back 5 years. If you want to change that setting, you can do that. Go up to the gear, go to application settings, and it's going to bring it up. And I think it's under calculations right here. Calculations, you can change your beta setting right there if you want, okay? You can get that beta setting right there if you want. I have it on fast beta. Now, NVIDIA, you'd probably guess, it's a tech stock. Tech stocks kind of are known for higher betas. Not all do, but that's kind of a typical one. Here's 3M. What's my beta? About 1.3, okay? Moves much more in line with what the S&P 500 does, maybe a little bit more. All right, let's look at another one real quick. And I don't want to spend too much time on this, but let's look at Johnson & Johnson. Beta's pretty low. In fact, when beta becomes very, very low, it doesn't necessarily mean it's not volatile. It just means it's kind of less correlated to what the S&P 500 is doing there. Okay, so that's the first concept I want you to know, is beta. The second concept is one we discussed last week, and that is how much an individual position is going to move in relationship to the S&P 500, and that's into a move in the underlying stock. So I have a delta column here. Okay, I have a delta column. This is Allegiant, okay? I have 100 shares of Allegiant. If Allegiant goes up $1, this position is likely to go up about $100. Why? Because I have 100 shares. If on a stock, your delta is just going to be the quantity, okay? If the stock moves $1 and you have 100 shares, your position overall is going to move about $100, up or down, right? If it goes down $1, we're likely to lose $100 on that 100 shares of stock. If I look at, let's see, I have Delta Airlines. I have 50 shares of stock. My delta is 50. Okay, with stock, it's easy enough. What about with an option? With Caterpillar, I have an option. I have a call option. My delta right now is about 81. That means if the stock Caterpillar goes up $1, I'm going to make about $81 here on this option. If Caterpillar goes down $1, I'm likely to lose about $81. Okay, so there we go. That's delta, and of course, different types of options positions entail different deltas. Again, we talked about that last week. If you'd like, you can go back to last week's session here on this. But there's a problem here if we just look at delta and consider the impact on the portfolio. Let's consider these two. Let's look at Caterpillar and let's look at CNP. Which is going to have the bigger impact on my portfolio right now? Caterpillar or CNP? Looking at this, you'd probably say, well, CNP is probably going to have a much more significant impact on my portfolio if you just went by this. But the fact is, if the market moves up because of their betas, one is likely to move significantly more than the other. In other words, I can't compare a $1 move in Caterpillar stock with a $1 move in any other stock, or Bank of America, or Bank of New York Mellon, I should say, excuse me. I have this, a $1 move in Bank of New York Mellon is very different than a $1 move in AVGO. One's a $375 stock. One is a $113 stock. They're apples and oranges. So if we beta weight them, and you can do this on Thinkorswim by just clicking right here, and I'm going to pull up the SPX, I'm going to beta weight to the SPX here. What it's saying is, given a 1-point move in the SPX, how much are each of these positions are going to move? Well, look at my delta here. You can see my deltas. And when I talk about deltas and their potential moves, just realize they're estimations. They're estimations. It's not a guarantee of exactly how much any stock is going to move. Remember, to come up with your delta, to come up with your beta weighted delta, we're looking at a past price movement. That's no guarantee of what future price movement is going to be. Okay, but let's look at these. You can see how much is going to impact the portfolio the most. Oh, AVGO is going to have a pretty big impact on the portfolio. Caterpillar, pretty impact on the big impact in the portfolio. Kraft Heinz, probably not as much, smaller impact on the portfolio. We can sum it all right here. This is my total beta weighted delta of my portfolio, around 32. Okay. Well, how much does that really mean in terms of a move? $32 essentially per point move on the S&P 500. Well, how much is how big is the S&P 500? The S&P 500 is like at 6,800 something right now. Let's do SPX. It's at 6,839. A 1% move on this is a $68 move on this. So a 1% move on the portfolio, I'd have to take 68-point move on the SPX times my delta is times 32 is about a $2,200 move on my overall portfolio. A 1% move in the S&P 500 is going to be about a $2,200 move on my portfolio. Do you see how this is important? Let's say the S&P 500 goes down, what we'll say 5%. That it did that not too long ago. We had a 5% pullback, or pretty close to that at least. And how much would this particular portfolio be affected? Well, I'd take my delta, multiply it by about that 68 level, and we come up with, I think it was about $2,200. I would take $2,200, that was 1 times 5. Well, that's about an $11,000 impact on my portfolio. About an $11,000 impact. Can your portfolio withstand that? If this were your portfolio? Maybe. And maybe that's okay if we were to have that pullback. What each of you need to do, though, is you need to figure out for your own portfolio, number one, what it is, and number two, is it appropriate for your level of risk? Are you comfortable with the drawdown by a certain amount? You have to be, now you may be saying, I'm not comfortable with that drawdown. I'm not comfortable with any drawdown. I don't want to lose any. Well, if you're going to be in the markets, you're going to be taking risk here. And there's risk mitigation tools that we can take that we talk about each week in here, things like stop losses, which aren't guaranteed. But you got to think about your overall portfolio risk, and using a beta weighted delta is key to that, I think. You got to check beta weighting here. For our purposes, I'm using the SPX. You don't have to beta weight to the SPX, but that's the most common index that people beta weight to. And then you can come up with your figure. Remember, I'm using a 1% move, which we said was about $68. I multiplied that, just in our example, by a potential 5% drawdown. And that gave me $11,000 given my beta weighted delta. But a 5% move isn't that uncommon. How often does a 5% move occur? Basically, on average, about every year we get a 5% drawdown in the market. Okay. What about a 10% move? About every 1.5 years, we get on average about a 10% drawdown in the market. How about a 20% move in the market? That's a pretty big drawdown on the S&P 500. A 20% drawdown. About on average, roughly every 4 years, we get a 20% drawdown in the market. And it can go more than that. 30% drawdown, about every 10 years, we get about a 30% drawdown in the market. It's, I don't know when it's going to come again in the future, but you need to be prepared for it. So if you know the math and you know how to figure that out, then you can see what your portfolio risk is there. Okay. Now, Mary said, hey, I have different groups here on my page. I want to know how to get my delta for all the groups together. Here's what I did. I just went to the little gear, and instead of show groups, I accidentally clicked on something else. I want to close that support panel. Instead of showing the groups, okay, where it's hard to see that. But if you click on this little gear and you just want to look at your overall portfolio, just uncheck show groups. You can recheck it if you want to. And that's how I get my total there on that. Okay, good question. All right. So let me just kind of summarize this portion right now before we move on to the next portion. Consider not just the individual delta of the stocks or the strategies that you are trading. We talked about that last week. Consider the impacts on your overall portfolio and what your existing portfolio is there. Now, let's look at this. Right now, I have a beta weighted delta of around 32. We already mentioned that. I have a negative theta. I generally like to keep that pretty small or positive if possible. The negative amount, I'd like to keep the negative amount small, but if possible, I'd like to get it positive. Can I create trades that can affect these things? My vega, okay? Maybe I want to lower my vega or something. You can affect each of these measures of Greeks here. But right now, I'm going to concentrate on delta. Because we can do things like iron condors or calendars and affect our theta and our vega. We can do things like long calls or just a plain short put and affect these. But if you really want to affect delta, you can affect it. You got to consider the strategies you do. An iron condor probably isn't going to affect your beta weighted delta much. Okay. A calendar spread, a short vertical spread is unlikely to affect your beta weighted delta much. So if I want to affect this a lot, what you may consider doing is you may do something like a long call or long put. If I want to bring this down, if I want to lower this down, if I'm a little concerned, maybe my risk is a little bit high, then maybe I put in a long put here. That's certainly going to affect my beta weighted delta. My theta, I do the long put. It's probably not going to help me in that regard. But right now, this is my bigger concern here on my portfolio. So I'm going to look to do that. Now I can put it on an individual stock here and beta weight it. But if I want the most direct correlation to the SPX, you can look at index options on the SPX. Now, let me mention this. We have a whole webcast on trading index options. It occurs on Wednesdays. Today's a Wednesday. So I'd encourage you to check it out. Trading index options, 3 o'clock on Wednesdays. That is taught by 3 o'clock Eastern time. That is taught by none other than Mr. Ben Watson. Okay. It's a great class. And I'm going to actually trade an index option here today for our illustration. But most weeks we don't do that. Okay. So this is going to be the exception. If you want to learn more about trading index options, 3 o'clock Eastern time today, check that out. Okay. Now, let's go, and I'm going to go to the Analyze tab here. And I want to look, I'm not going to do the SPX, and here's why. If I do the SPX, and let me go out, we'll go out a little ways. We'll go up past the new year, okay? Let me go to January, I don't know, January 16th. Doesn't matter, okay? And I look at this, and I start doing this trade. This is a very expensive option, and it impacts the portfolio a lot. So what I'm going to do is I'm going to do something that's actually has a similar direct correlation. Okay, we don't have to worry about betas on this because the beta on the SPX is going to be 1. You see why? Remember, the beta is telling you how much something is going to move in relationship to the S&P 500. This is the S&P 500. Okay, so the beta is going to be 1. But what I'm going to do is, instead of something that is trading at $6,800 a share, one approach is you could use ETFs. I'm not going to get into ETFs. Carolina mentioned that in the chat. I'm not going to get into ETFs today, but I'm going to put in another index option called the XSP. Okay. Now notice the price on this. Does it look kind of familiar? Yeah, it's just 1/10 of the price of the SPX. So it's going to have less of an impact on it. So let's do this. Let me go here. And I'm going to go out to January. And I'm going to go out and, I don't know, we'll go out to January 16th again. We'll stick with that, okay? And I'm going to basically go out at the money, 685. And I'm going to just look at this I'm going to add this simulated trade here. Actually, let me do this here and just show you this way. Here's XSP. We're going to January 16th is, I think, what we said. There's nothing special about January 16th. You could do one of the others. A lot of expiration dates with these index options. And we said 685. And we're going to watch the liquidity there. Okay, bid-ask spread is nice and tight. I'm just going to click on this. And this is how I would place the trade. But I want to analyze this trade. So I'm going to right-click on this. I'm going to analyze the trade. Now, when I click on risk profile, I can see that long put, okay, just like we always see it. But what I'm going to do here is I'm going to see what impact this has on my portfolio. So I'm going to beta weight it. I'm going to beta weight it against the SPX to see what its impact would be. My delta here is going to be about -4.5. Now, delta changes as the index changes, the stock changes. But right now, it's about -4.5. So if I do this trade, what would a -4.5 do to us? It would reduce my delta from about 32 down to about, what, 27 and a half. Okay? That's the impact it would have. Now, why am I not doing the SPX? Because if I did the SPX, what would my delta be? My delta would be 10 times that amount. Because remember, the XSP is 1/10 the amount of the SPX. That put about negative 45. Well, look, negative 45 is, it would massively affect this portfolio. It would change it from a positive delta for portfolio, which is kind of what I want, to a negative delta portfolio. It would be like I'm trying to hang a picture on a wall with a little Brad, and I get out a sledgehammer on the thing. Okay? It would just be too much. So that's why I'm using the XSP in this case here to do that. Now, is it going to have some negative? Well, it's going to have some negative effects. It's going to bring in some more negative theta there. Okay. And it's going to have more positive vega. That's not necessarily negative. It just depends what I want. But the theta, I'm just going to say negative theta is not what I want. But one of the prices you pay for a nice big delta impact is that negative theta. Okay, so let me go here. I'm going to trade this. I'm going to confirm and send, and I'm going to send this. Yeah. Now we filled that. And now, looking at my overall portfolio, look at my delta, about 27 and a half, just like what we said. Okay. So there you go. Consider your whole portfolio as you're adding on new trades. You can affect these numbers by adding in trades. You can also affect them by taking off trades. If I wanted to have a big impact on this and lower this immediately, what I could have done, the biggest impact I could have done there was I just remove AVGO, remove Broadcom from the portfolio. That certainly would have done that. Okay. Question. Okay. Harry said, could we have used a spread on the SPX? Yeah, we sure could have. Yeah. I mean, think about it. In this case, what I did was a long put at the money, which is going to have approximately a negative 0.5, well, depends if you, a negative 0.5 delta, okay? What if I did a short call vertical on the SPX? Well, what's the delta we have on it? And this goes back to last week's discussion. What's the delta that we have on the SPX? It would be, it depends what strikes you pick. Maybe 0.1 to maybe 0.15, but it would actually be more because the SPX is 10 times as much as the XSP. However, there is a difference between doing a spread there and this. Remember, spreads are going to limit your gains. Let's say this portfolio let's say the SPX does go way down. What's going to happen to that that XSP position? My delta is going to get more and more negative from let me unbeta weight it here for a second. From minus 0.45 to go to minus 0.60, minus 0.70, minus 0.80. This gets more and more, I guess, protective in the sense of a portfolio drawdown, whereas the spread is going to cap out much smaller there. Okay. All right. There we go. So let's move on to some other things. Let me just address questions. Am I concerned with no volume on the XSP? No. First of all, I don't even look at option volume. I'll look at option open interest, but option volume resets each day, okay? There's a bazillion contracts on that XSP that we were looking at there, okay? Remember, XSP. So I'm much more concerned on this when you're going out. Remember, if I look here, here's why there's so many, there's expiration dates pretty much every day here on this. So it's all going to be spread out. Now, as they get closer, the volume will build up, the open interest will build up. But I am concerned, and we did check that, I am very concerned about the bid-ask spread. Make sure you have that nice tight bid-ask spread. This is these XSP options are relatively heavily traded options. Not as much as the SPX, okay, but they are still relatively heavily traded. But it's a good point you brought up, real Enrico, because I do want you to be aware of the liquidity of these trades, and it is a concern on these trades. Okay, let's move forward because I want to get to some further trade management. Okay, good beta weighted number. Remember, it depends on your portfolio. On this one, I said, if I remember it correctly, a 5% drawdown would cost me $11,000. On this portfolio, that's okay. For your portfolio, that may be way too much. That may be way too much. You have to realize what risk you are comfortable with on these. So I can't give you a number on that. Now, could you use, if you don't want to use the XSP, an ETF or something? You could. We have a webcast, talks about ETFs. Friday mornings, 9:30 Eastern time. But yeah, you could, absolutely. Okay. So I can't show ETFs here in this class though, in this webcast. So that's one reason I'm not doing that there today. Let's go and let's look at our charts. And I'm gonna go back to my groups here. So just a reminder on how to do that. You can just go show groups. Okay, if you have groups set out, and I'm going to go, let me move this up here. And I'm going to start from the bottom this week because last week I started from the top and sometimes I don't get through them all and we're going to run out of time here. So I don't want to do that. Okay. So I'm going to go with this. Let's look for a sec at NVIDIA. NVIDIA, I have a back ratio, I have a front ratio spread on NVIDIA here. This was entered almost 2 weeks ago. And we're doing okay on it. Okay, we're doing okay on it. But here's what I want to point out on this. I want to point out, I want to see where do I want this to go. On some trades, it's obvious where you want the trade to go. Okay, long call, I think most people know I want the stock to go up. Long put, I want the stock to go down. Short put, vertical, maybe clear enough. Maybe it's not as clear on strategies you don't use as much. So one thing you can always do is you can go to the Analyze tab. Okay, the Analyze tab is not just for looking at potential trades. You can look at existing trades on there. I'm going to get out of that. I'm going to go back to single symbol on this. And we're going to look at NVIDIA. And here's the trade. Now, if you see red and green colors, these down here, those are simulated trades that you're looking at. In this case, this is an existing trade, an existing paper trade, but that's the trade we're looking at here. And I can see from this, by bringing this up, if I didn't know where I wanted NVIDIA to go over here, it's this front ratio spread, it's a little bit kind of this weird trade I'm not used to, go to the Analyze tab, and you can see, here's the current level of NVIDIA, and we're actually doing pretty well on this. But ideally, we want the stock to go up. That'd be nice. If it was bullish, we would probably, there's no guarantees on it, but we'd probably see more of a profit here if the stock goes from its current position here up. And we probably wouldn't see that much downside if we go down, okay? Right? That's kind of the construction of this back ratio spread or front ratio spread. We did this a couple weeks ago in our condors, calendars, and butterflies class, by the way, if you want to see these. But this is kind of a nice risk profile. So we're bullish on this, but we're not too bullish. Okay, so let's just take a look at this. So in my mind, maybe we stick with it because it can get a lot better, it looks like, than where it's at. I've got 16 days to go to expiration, so time's ticking down, but we still have enough time that we can stick with it. And we have an exit on this. Let me just check out NVIDIA here. NVIDIA, if NVIDIA marks greater than 208, well, where are we at? We're down here. So if it goes way up here, it's going to have us exit because that's going through that profit zone. But I think I don't see any compelling reason to trade this at this point. So I think we just stick with it. So in terms of managing this particular trade, we're just going to keep hands off on that one. Okay. Let's go to some other trades. Let me go here. Here's Kraft Heinz. We're down a little money on this. We're losing a little money on this. This is a synthetic, okay? We've got long call, short put, same strike, same expiration. So this, typically we're going to treat fairly similar to just a long stock trade. If it's trending up, looks great, we're going to stick with it. If it's trending down, we're probably going to get out of that. And of course, if we're getting near expiration, we'll look to get out, but we still have 44 days. Okay. So now let's look at the chart and see what we got. Now remember that I still have NVIDIA here. Mary says, any concerns about head and shoulders pattern? Remember, I'm not that concerned about it. I would be concerned, but if it goes down on the trade that we were looking at, Mary, it's not going to negatively impact the trade. If I was very bullish, if I needed this to be bullish and I was facing a big loss if it went down, then yeah, I would be quite concerned about that. But in this case, in the trade that we have, it's fine within reasonable ranges. Okay. Kraft Heinz. This is a long synthetic. We got in back here expecting this to continue up. We've had a little bit of a pullback, okay? And so we're down a little bit on this. This was a little bit, and we said it at the time, this was more of an aggressive trade. We knew it was trending down, and we were trying to catch the change in trend here on the breakout from there. Well, so far it's not going great, but one thing we could do is we could say, let's just add a stop in here. So I think that makes sense, adding a stop on Kraft Heinz. And so what I'm going to say is, look, it looks like we're probably bouncing. Let me zoom in just a little bit so we can see it a little better. It looks like we may be bouncing here. I'll go off this low. But if we break below here, maybe to 24.5, I'm going to look to get out of that. So that'll just add a little, hopefully add a little protection here on this. To get out of this, I'm going to make it a market order. I'm going to make it good till canceled. And I'm going to click on the gear And I'm going to say we're going to get out if it marks less than or equal to 24.5. So we're going to give it a little more time on this. Now, we're going to save that. If you wanted to, let me confirm and send that. Okay. And send that. Could you say, well, look, I gave it a shot to go up and it's been kind of going down the last few days. I'm just going to get up. You can do that. I'm going to be a little more patient with that. I'm going to look for it to bounce, hopefully off this 20-day moving average here. Okay, let's keep moving forward. Let's go to, here's one that's going to expire soon. And that is why am I not? Oh, there we go. I scrolled down there. Okay. Here's Nike. Okay. So Nike, we have a diagonal spread. This was kind of our poor man's covered call. We've rolled this several times, and I'm going to roll it again. We got 2 days to go till expiration on this. 2 days to go to. So this basically is worth nothing at this point. And so what I'm going to do is I'm going to continue with this. We've been getting hurt really badly, but this is like this is more of an experiment than anything. We're just going to see how much premium we can get by continuing to roll out those call options on Nike. So I'm going to roll this out. Let me go to the trade tab. Let's go to Nike. Okay. Here's my current position right there. I'm going to roll out about a month. And I'm going to go somewhere up here. Let me go actually. Do I have the liquidity isn't great on those. Let me just check these. So the liquidity is not great here. I'm going to go to those monthly options. I'm just going to go out 16 days here. We probably get better liquidity on these. Yeah, we're getting much tighter spreads on those. I'm looking to look to sell this out. I'm going to go just as a marker to about what a delta of about 25 to 30, somewhere in here. I'll just do the 25 delta. We're going to roll this to a 72 December 19th contract. That's going to bring in about $100 or so. So 72 December 19th. Now, Delta tells us how much the stock is going to move in relationship to a $1 move how much the option is going to move in relationship to a $1 move in the stock price, but it also gives us an idea of probability. It can give us a ballpark figure that there's about a 25% chance this is going to be in the money at expiration. 72 December 19. So let's roll this. I'm going to create a rolling order. And we're going to go out to December 19th. And we're going to make it a 72. And that's going to give us about $113 credit, not factoring in commissions there. Okay? So we're going to roll that out again. I'm going to confirm and send this. And actually, it's coming at the mid price, of course, because it's a spread. I'm just going to go down just a little bit to try and get filled on that. Make sure I get filled on that. Confirm and send that, and it's thinking. I may tweak that if it doesn't fill soon, but we are out of time, folks. So I think we accomplished what I wanted to accomplish, and that is I wanted to talk about beta weighting a portfolio, considering your whole portfolio, not just individual positions. And so what delta is, what beta is, how to beta weight a portfolio practically, how to consider your risk. We talked about that. How different trades can impact that. We gave you an example of an index option trade to try and affect the overall beta weighted delta on the portfolio. We didn't get to all the trades I wanted to today, but we did talk about a front ratio spread. We talked about managing a synthetic. We talked about this poor man's covered call and how to roll that out. Hopefully that was beneficial, everybody. Thank you all for joining me. Make sure you subscribe to the Trader Talks channel. And that way you don't miss future content here of this webcast and other webcasts as well. And coming up next, we have trading price patterns. And then later in the day, remember, we've got that trading index options class as well. So thanks, Ben, for helping me out in the chat. Everybody have a great rest of the day. Bye-bye.